Folks. It's Dave Burrows. I am CEO and Chief Investment Strategist at Barometer Capital Management. I want to thank everybody for joining us today. It's been a busy week, and it's supposed to be March break. I was hoping to get a bit of skiing in with my kids, which I'm sure I will do at some point, but markets take precedent right now. We get into markets like this, and there's a lot of things you can take away. There's a lot of information that comes, a lot of stress testing of your positions. And I love to, spend the time to go through the process to prepare for these webcasts because really it forces us to look at a whole lot of charts. Look, investing isn't about perfect. It's about getting it as right as you can. It's about making sure little mistakes don't turn into big ones. It's about reevaluating your stance and your position. And the market's going to show you whether you're right or wrong. And sometimes you have to recognize that something's changing and you got to get out of the way. There's no need to be fully invested all the time. I think the most important thing I take away is that our client's biggest fear is losing the money. And so making sure we're good at selling is really, really important. Making sure we don't have FOMO and rush into some new position just because we think prices are low. So with that, let's just start from the top and take a look at what's been going on. Obviously, the S&P is having a rough month, right? Down 6.8%. S&P made its first new high in January of last year, so just about 14 months ago. The secular bull market that started in 2013, it was like 144 months long. The bull market in the 80s and 90s went 217 months and went a whole lot further in percentage point terms. It doesn't mean it has to always do that, but that's something that we tend to follow and understand where we are in the scheme of things. We know that during secular bull markets, you have cyclical bear markets, like we did in 2014-15, where the market came down and tested the rising 200-week moving average. Like we did in 2018, that was a short, sharp, very quick reversal and painful. You had the COVID sell-off, which came down and tested that rising 200-week and actually breached it briefly. And you came down and touched that level in October of 2022. So we're a long way above that level. I think it's way too early to talk about a bear market, but certainly there are challenges in certain parts of the market. When we look at the S&P 500 chart, it's off 9.92% off the high. And that was a very brief failed breakout attempt in the month of February. And we're now trading here below the rising 200-day moving average. So that's significant. I like to say not a lot good happens when you're below the 200-day moving average. You can see we touched on it in October of 2023 and quickly reversed. Maybe that will happen again. But as it stands, that is one of those things that gives you pause. We talked about the fact 3 weeks ago when you breached this lower support level that something was changing. And we talked about the fact that seasonally, February and March can be tricky in an inauguration year. We're learning about new policy coming out of the new administration, and we're in that period of time right now where markets are uneven. I'm not sure I can blame all this on policy because some of the weakest parts of the market have been relatively underperforming the S&P now since June of last year, way before we had an idea who was going to win this election. When we look at the Qs, the NASDAQ 100, it's off 13.34% as of about 3 o'clock this afternoon, and not showing any sign of reversing. It's been a very steady dripping decline. We breached below that 200-day last week, and then Friday, Monday, Tuesday. So look, there is cause for some caution. If you look at the NASDAQ 100, the relative strength versus the S&P, this blue line, has been underperforming the S&P since June. So we've talked about the weak relative strength in tech and what an important part of the market it is. The Mag 7 are like 50% of the Q value and close to 30% of the S&P 500. So for those that invest in indices, you take on a lot of exposure to those companies. And so it's really important to understand what's going on. Now, certainly there is a lot of uncertainty that this administration has put into the market. And many would say that it's been intentional. We talked about it last week, the idea that 1/3 of the US debt comes due this year, and that if they were able to weaken the market and weaken the economy, rates could come down and make less expensive to refinance that debt. I'm not sure that a government has that much power, especially when it's going against the grain and the interest rate cycle. But it doesn't mean that they aren't going to try. We have talked about the fact that US stocks are exceedingly expensive relative to the rest of the world. We talked about it on a measure of price to book. We've talked about it on a CAPE ratio. So the 10-year cyclically adjusted PE ratio relative to the rest of the world. Tech, obviously, most expensive. And US at 33 times, where we go down to the other end of the spectrum. And some of the European countries are very, very inexpensive. We talked a little bit about Argentina over the last 6 months and the fact that the Argentina stock market's been going through the roof. I put this scorecard up a few times over the last few weeks because I think it's really important that we recognize these changes. Right? Global stocks are way outperforming the US this year. I think when I first put it up, the US was at the top of the third column. Last week, it was just about the middle of the third column. This was as of Friday. If we looked at it as of today, it would be probably closer to the bottom. So rotation takes place from time to time. The fact that the Eurozone equities, and in particular, this is the Eurozone ETF, we were to look at the Euro Stocks 50, they're making new highs for the first time going back to 2008. That's a change, right? This is a secular bear market, a multi-year period where the market makes no gains. And when it does finally make gains, something's changing. Now, it's not impossible. European investors are seeing a weakening US dollar, a bunch of policy that they don't like to see, and they're saying, we're going to take some of our money home and put it into our market. The biggest inflow into Europe over the last couple of weeks that we've seen in some time, but it's the beginning of something, right? We've talked about this chart now for 18 months. Global stocks are cheap relative to the rest of the world. And frankly, they have almost no technology exposure. So if technology is underperforming, this is a place that doesn't really get impacted. We talked last week about earnings revisions that are being revised higher so far over the course of the year in Europe and lower in the US, Citigroup US earnings revisions index. This is an unpopular topic. In the fall of last year, we added a China exposure to our global fund. And my market, you cannot put 30% of the global fund in China. People are going to hate it. But it's been a huge contributor to returns because within that market, there's some great companies. There's some rocky ones too, and it's about picking your spots. But it's is performing really, really well in this market. We talked about Argentina being a contributor. And frankly, the TSX has been performing pretty darn well after a long period of underperformance, partly because it's very inexpensive relative to US stocks, partly because the sector makeup is more suited to what's going on in this market. Same with Europe. Financials a very big weight. I don't want to see Donald Trump because the TSX has been outperforming the equal weight S&P now since 2021. And so far this year, this is the last 4 months, TSX rising relative to the equal weight S&P. So I know I worry about tariffs like everybody else does. But I've tried to say that tariffs and policy are one moving part, and there's 1,000 of them that make prices move in the market. And if it is that technology's into some difficulty and financials are leading, well, the markets that have lots of financials are likely to do better. So after 13 years of US stocks way outperforming international, we're getting international stocks leading. And part of it may be that the US dollar, after a period of exceptional strength, is really falling in price relative to the euro, the pound, the yen, and frankly isn't gaining versus the US dollar, or sorry, the Canadian dollar. Now, this poses an important point, and we talked about this last week. The Japanese yen, for the first time in 20 years, is rising versus every currency. For 20 years, Japanese have taken yen, borrowed it at a low interest rate, converted it to US dollars, watched the currency in US dollars rise, and invested in which were consistent leaders. If US stocks aren't leading and the US dollar is falling and there's stuff to do in Japan, you may well see that money be repatriated. That's the unwinding of the carry trade, borrow at a low cost, invest at a higher rate of return, and that's no longer working. Frankly, it's not working in Europe either. Interest rates are moving higher in the rest of the world. Now, there's a discussion that Trump and the administration and Scott Bessent are looking at finding a way to get the yields on long-term treasury bonds down to refinance. But if nobody wants to buy them because they can buy their own currency where it's going higher versus the dollar and the rates are going higher, they can do better. And even more if their stock markets are doing well. So the devil's going to be in the detail. All I know is from the chart on relative strength, we became overbought in the fall of last year, like we did in September of 22, like we did in May of 22, and we looked for a correction. So a Barometer Global Equity Fund now since inception at the end of December 23, which we started because we thought global stocks could start doing well, is up to today, up 40.5% over the last 437 days versus the MSCI All World Index in Canadian dollars, up 22. It's doing exactly what we hoped it would do. And we've been busy moving people from a 5% weight to a 10% weight because, frankly, I think it can go on a long time. We're really happy to see in Morningstar that we rank in the top 1% of 1,100 and some odd funds. That was as of the end of last week. I think we had a pretty good darn day today and a good day yesterday. But this is the beginning of something, right? The MSCI All World ex-US Index relative to the equally weighted S&P started to relatively outperform back in 2022 and very clearly is now broken this long-term trend where global stocks were in a bear market relative to US stocks, are now in a bull market relative to US stocks, and they're darn cheap. Going to fixed income, fixed income yields continue to be sticky. I know that they are lower interest rates on treasury bonds. Hasn't had much of an impact. If we look at the impact on the TLT, which is the long US Treasury bond ETF, it's been in a bear market since 2020. There is no sign that that's changing. So bonds to us less attractive. Inflation has been a problem, and disinflation is why you would want to own bonds. Stocks relative to bonds have been outperforming. Now, over the last few weeks, you've seen stocks pull back, and they've done that a number of times. We'll see what happens going forward. But one of the places we're seeing money goes to commodity prices. Commodities went through a market from 2011 through 20. And when inflation picked up, we had a first big bump higher, which almost nobody recognized because nobody was interested in commodities. The central banks around the world tightened rates through 2021 and 22, and that held things in check. But frankly, certainly didn't choke off prices. And now month by month, we're marching higher again. We're up on the month in the month of March against a pretty tough financial asset market. Gold making new highs. we're within a whisper of new highs, up 44% above the long-term moving average. But that can go a long way. Silver, similar. No sign of weakness here. Copper. After coming down and testing the long-term moving average in the month of December, copper prices have been marching higher since. This has the potential, copper prices are an important contributor to inflation. Copper is an important input if we're going to build data centers and we're going to build new power to power the data centers. If we're going to build electric cars. Apparently, Donald Trump decided to buy a Tesla today. This is going to be an important indicator. And frankly, they've called it Dr. Copper for a long time because it does give you a sense for what's going on out there. So commodities relative to bonds. If we're looking at hedging a risk, the commodities market would say that the risk is still inflation, not disinflation. Commodities relative to the equally weighted S&P, this is kind of a big deal. Had an initial period of outperformance and a consolidation, and now over the last 4 months, commodities moving up relative to the equally weighted US stock market. So we have to recognize these change points, and they take a long time, right? People time feels like a long time between 2022 and 25, and that's just a big transition point in the market. Once it gets in gear, it can go on for a decade. So we have to watch these things. I think this is one of the most important charts that I have in my deck. If you plot gold's performance relative to the performance of the NASDAQ 100, gold turned up relative to the NASDAQ in the early part of the year 2000. Now, that was the beginning of the tech wreck. And I'm not saying we're going for a tech wreck, but once it gets in gear, it can stay in gear a long time, and it did on a relative basis, outperformed until 2011, 10 years later. And at that point, tech stocks woke up and took off and made new highs. And gold has underperformed since then. Now put in a first low relative to tech in 2022, and then made a higher low at the end of the tightening cycle in 23, and very clearly has shifted on a relative basis versus tech. So not a popular chart, but it's one I think that we have to be recognizing. These change points can be important. This change in 2020 was where we started our income fund because we thought we were going to need a different source of return. And it's been a great performer ever since. On currency, we are watching the Canadian dollar because we do have assets here and our clients live here. And as a result, it's really important. I do think it's interesting with all of this vitriol about trade in the 51st state. The Canadian dollar is failing to make a new low. So this to me speaks to resilience and a likelihood actually the Canadian dollar can work its way higher. We'll see. We're going to have to get more defensive on our currency stance. But as it stands right now, we've now hedged back to Canadian dollars. So look, we don't have to be everywhere. Our job is to make decisions. I think our client expectation is that we're going to focus all of our attention in trying to own parts of the market that people care about, that are being positively revalued, the alternatives. Leadership could be sector-based or theme-based or asset class-based or geographically based. Our job is to focus in those areas that are leadership. We're always watching for change, new leadership to emerge, old leadership to recede. That's why that gold versus NASDAQ 100 chart is so important. And sometimes there's an absence of leadership, which means we have to play defense. So we're being hired to be tactical. If people want to just own the index, they go buy the spider for free. Now you take on 30% of the portfolio in tech, which may not be the place you want to be going forward. We've always felt that it was important to be in parts of the market that we're seeing expanding breadth. What do I mean by that? It means if there's 100 stocks in the sector in a healthy period of time, more and more stocks within the sector should be in clear defined uptrends. This is a really important concept. There's no place while more and more stocks are performing well. And during those periods of time, we're very happy to be invested. 70% of return comes from getting to the right neighborhood, right? So we're looking at all of the various areas that we could be focused, looking for areas that are seeing expanding breadth. Those are our buckets we want to focus on. And then we want to find securities within those buckets from our bottom up work that are fundamentally sound, that are technically sound. In other words, price behavior is constructive, working its way higher and higher highs and higher lows. And when we can find both of those things, that's our farm team. And when we can find securities that match up in the groups that we're interested in, that's where our portfolio should live. And that's great when things are going well. However, recently, breadth has been deteriorating across the top tier. Trends in Canada, in the US, and globally has been backing off. So that gives us pause to put on new positions. If breadth is contracting, we don't add new positions. Underneath the surface, the percent of stocks trading above the 50-day moving average has been moving to the left, meaning a smaller and smaller percent of stocks. Now, there's lots of stocks that are, but more and more day by day, fewer and fewer stocks are staying above their short-term moving average. Percent of stocks with positive weekly momentum has been contracting. Percent of stocks making new highs versus new lows contracting. Percent of stocks trading above their 150-day or 30-week moving average also contracting. Now, this can be a short-term issue like January, February, or February, March, or it could be something longer. It's not up to us to guess. It's up to us to measure this. And so long as we're seeing contraction in breadth, it means that we have to be more cautious, right? There's higher risk. It's easier for one of the positions that's working to stop working. When things are sloppy from a breadth perspective, we raise some cash. So we start with 7 or 8%. We're right now in our funds between 30 and 40% cash. In the accounts that may have separately managed holdings and some funds, we probably are a little over 20% cash, plus the cash that we have in our funds. So we tighten up our stop losses. Every position has a stop loss. As the position works out as we hope or expect, we ratchet the stop loss up and behind. It means that we stay in the positions as long as they work. And the ones that don't come down breach our stop loss, the money moves to the sidelines, and we stop putting on any new positions. I don't talk about this a lot. It's during a period like now, we're building our farm team. Because as the market is stress testing stocks, there are some that people have so much conviction in, they're not willing to sell and they hold up in price. It's kind of like a wind coming across the desert. It blows away all the sand and the dust and the tumbleweeds and leaves some solid boulders exposed. To the extent they meet our business tests, they're technically sound. We put them in our farm team, we do our due diligence. And eventually, when we start to see the spread data improve, if it's held up all the way through a decline, it's likely to participate very quickly to the upside. Now, in the very short run, the put call ratio, the number of puts that people are buying, betting the market's going down, versus calls that people are buying, giving them a call to buy shares going forward, that's generally bullish. Generally, at some point when we're getting close to the end of a sell-off, the puts spike. And we haven't seen that happen yet. Not to say it has to happen, but that's a sign that we would be watching for the fact that we're getting close to the end of a sell-off. Let's talk about leadership for a minute. Leadership has been financials. And this is a very long-term chart, 2007 through 2020. And financials have been clear leadership. This month, they're down. But when we look at things on a relative basis, relative strength has continued to improve. In other words, this sector has continued to improve relative to the rest of the market, even though it has certainly pulled back some. Insurance has been the strongest group in the market for a long time. Relative strength is actually making a new high, even though it's pulled back a little in price. Stocks pull back. We see this all the time. But just because stocks pull back doesn't mean they should be sold. It's when trend breaks and relative on top of it, it means that we can stay in the strength and sell the weakness. If we look at global financials, they're also making relative strength new highs. Okay, it's not just US, it's global. Look at the EUFN ETF, European financials, made up of HSBC, Allianz, Sempo, UBS, Zurich Insurance, Santander. They've been on a tear so far this year. So as the US dollar has been weakening, it looks like global investors will buy European stocks in euros. And look at the relative strength push, something you have to recognize. EUFN long-term chart making its first new high in this year, in the early part of this year, that is made going back to 2007. That's the beginning of a new bull market. So financials are leading around the world, and it's really important because global stocks have a lot of financials in them. Industrials. This is an equally weighted basket of industrial companies, certainly has been correcting, trading above the moving averages, and it's a mixed bag. Aerospace, which includes defense stocks, relative strength continues to rise, or relative strength new high today. And over the last 4 days, while the market's been getting crushed, sideways and above the 150-day moving average. To me, that's a natural pullback. Unless this breaks and gets a lot worse, we need to be there. Now, if you look at European aerospace companies, well, they're continuing to lead. We own Embraer as an ADR, American Depository Receipt, trades in New York. Look at the relative strength here, just keeps on trucking. Howmet Aerospace leads for jet engines, better than 96% of stocks in the S&P over the last 52 weeks. Sure, it's pulled back a little bit, and it's pulled back a few times, but nothing broken. Fundamentally sound, technically sound, in a group that's behaving pretty well. John Deere, look at this relative strength push here, better than 93% of companies in the S&P, and only a couple of days really off the highs. The waste stocks, well, there's no tariffs on waste apparently. Waste Connections here in Canada, GFL's acted pretty well. Republic in the US, the whole sector performing well, and the relative strength maintaining strength. So it's not about making a binary decision to go 100% to cash, as we've had some client calls about. People only wanting to know, should I sell everything, go sit in T-bills? Well, no, because we don't know how long this correction is going to go on for. It could be short-lived, could be something longer. We'll see. Transports on the other side, not so good. Broken below all the moving averages. We don't have any, but this is something just to keep in mind because it has indication for what might be going on in the economy. Energy, again, despite concerns about tariffs on Canadian energy, there's an ETF equally weighted of the big Canadian energy producers. Well, we know seasonally it's a decent time, but there's lots going on here. In general, energy infrastructure has been strong both in the US and Canada. Our Enbridge position is performing just fine. The US pipes are performing fine. We've got LNG, Cheniere Energy, and the big gas producers, right? Expand Energy is a $23 billion producer of natural gas, made a new relative strength high today. You love to see at the first sign of strength, what is it that pops higher? This was against two very tough days in the market that Expand moved higher. Now let's move on to materials. Strength has been in the golds. I like to say that on a good day, the absolute leading stocks should pop right back to the surface. Agnico up 4% today, made a new all-time high and a new relative strength high. And frankly, been making relative strength new highs since February of last year. So it's 89% above the long-term moving average. We highlighted over the last few weeks that Agnico in the last bull market on 3 occasions got to 150% above the long-term moving average. This likely has a long way to go, and very clearly against a very tough tape is showing real resilience. Wheaton Precious Metals is the same. Alamos Gold is the same. Kinross is the same. We're very comfortable with our precious metals position. We're not gold bugs, but there's a time and a place, and these are hedging us against the risk of inflation. And frankly, I think that central banks are using gold treasury bonds. When we think about the cash flow and the dividends, difference between the all-in sustaining costs and the current market price have only been widening, which means that gold stocks are getting cheaper and cheaper so long as you're buying companies that generate cash. Cash flows nearing all-time highs, and prices are still 50% from all-time highs. So these can go up a long way. Copper producers, I'm watching with interest. They came out of this very long-term bear market. We've consolidated over the last couple of years. We broke out and pulled back into support. We'll see. The last 3 months, copper producers are higher against a tougher market. So if we started to get better breadth indicators for the market and for the sector, this probably would be an area we would look to add. So we're looking at farm team members here. Communication stocks, been great relative strength. Certainly are pulling back as they do, but nothing breaking. Communications relative to the equal weight S&P continues to be strong. So there is some continued areas of strength, but then there's the other side of the coin. Now, I had a lot of tough conversations over the last 7 or 8 months about technology. We don't disagree that there's lots of potential in AI, and companies like Apple and Nvidia and Microsoft and Broadcom, have had very, very good earnings and cash flow. But the market's telling us something when they started to relatively underperform in June of last year as a group. So this is the ETFs made up of the large cap tech stocks. I pointed out last week that technology broke the 200-day moving average for the first time in 526 days. And when that happens, it generally happens at a time when tech stocks are headed into a more difficult period. The semiconductor index, also relatively underperforming since June of last year, made a relative strength new low today, better than only 26% of stocks in the S&P, and is pulling back sharply. It's down 39% off the highs in July of last year. Keep in mind that when these corrections come, very often you pull back to the long-term moving average, which is about another 20% below here. And they're great companies. And if you want to ride them out, that's fine. That's not what we do. Semiconductors regularly have 30, 40, 50, 60% pullbacks, and we're just not willing to live through that. The Magnificent Seven is the ETF made up of the 7 biggest companies in the S&P 500, now down 23.9%. So even the biggest, best companies that everybody loves can run into difficulty, and we're now down through the 200-day moving average. This is what is likely having the biggest impact on the S&P. So there's some areas of strength and some areas of weakness. If you're an index investor, this has a big impact. Consumer discretionary has a big impact. Relative strength weakening now since December, and now below the 150-day moving average. Consumer expectations are weakening in the US. People are nervous. Real consumer spending month over month was down sharply in the month of January. We've long said interest rates and the housing market could give an investor, consumer pause to spend money, and that appears to be the case. So it's a group we're being careful of. Growth stocks in general. This is the Russell 2000 ETF, IWO. Again, very weak relative strength, below all the moving averages. It's had 2 legs down. Could it bounce? Any of these can bounce at any point. But look, things don't break down technically and then turn around and become leadership again immediately. There's time. I put up something yesterday on Twitter. This is no time for FOMO. It's okay to sit on your hands. It's okay to have some cash. And it's okay to say, what else is there out there that's actually doing way better than the market? Because leadership changes from time to time. Healthcare is certainly doing better. And we've talked a little bit about this. Medical devices, very, very well. Consumer staples have bounced. I want to be cautious here. When we get into the defensive, we can look at staples, we can look at REITs, and we can look at utilities. None of them are in uptrends. They've all had better relative performance recently. And we have to keep in mind that there's a lot of investors who are forced to be invested 100% all the time. Money managers who have chosen to be equity managers, where their job is to be fully invested. And so if they're pulling money out of tech, they're probably trying to hide somewhere else. And the idea of losing less to me is not the ideal. So hard for us to get excited about utilities, staples, and REITs when they don't technically set up well. And frankly, if the market starts to do better, they're not likely to lead the market to the upside. I'd far rather spend our time looking at things like copper and machinery that are pulling back within trend, but are not broken. So this chart's a lot like that one we looked at a moment ago against the NASDAQ 100, gold versus semiconductors. It's actually now been outperforming semiconductors since January of 2021. And again, this is likely the beginning of something much longer term than what we've seen already. It doesn't mean that it can't pull back in the short run, but it does look like that's a major change. We want to keep that in mind. So as of a week ago, we mentioned that breadth had been contracting. We mentioned that sectors on this distribution curve were moving to the left, meaning in general, weaker breadth. Last week, the average sector had 35% of stocks in uptrends. This week, the average sector has 31% of stocks in uptrends. That means that 30% of stocks are in uptrends. And so long as the stocks are performing well, we want to hold on to them. But we certainly don't want to add to sectors where we see in small letters, it means breadth is contracting. The ones at the far left here are the weakest. The ones at the right are the strongest. So we're seeing some breadth contraction in insurance now, but it's one of the strongest sectors. Banks, same thing. Precious metals are showing expansion and moving to the right. So there are defensive sectors that are holding up over the last few weeks, but have shown no real performance in 4 years. We're watching them, we're open-minded to them, but we're not adding anything because have been contracting as well. So where does it leave us? Firm-wide, we're about 26% cash. That's a little misleading because in some of our funds, we're more than that. And if we put the separately managed accounts together with the fund holdings, the cash position at a client level would be higher. Financials continue to be by far the largest weight. But when breadth contracts, we take a little money off the top and put it on the sidelines. So our exposure is down a little over a month ago, but still a significant overweight versus the market. Energy, same thing, significant overweight, but down a little over a month ago. Materials have hung in and actually have grown because the prices are going higher. Industrials are down about 3% in weight, but at the other end of the spectrum, we're still very low on utilities, very low on real estate, almost zero in technology, and that's started coming down almost a year ago. And consumer discretionary is 2%, healthcare is only 2%. So we're cautious. This can change very quickly, and we're ready to change our opinion when it happens. If a client has 10% in our global fund, 10% in our macro portfolio, which is a diversifier, global's up 10%, macro's down 0.6 of 1%, balance pool's down 4, income's down 4, equity's down 5. Somebody with that mix would be down 2.7% on the year. We're sitting with a lot of cash. We think we're in a good spot. We have optionality. Things that we keep in mind. The number of central banks where the last move was a rate cut, in other words, loosening, tends to go with inflation, GMI prices index. So we think that typically you would see prices move higher for goods, and that's inflationary. We want to protect against inflation. We're watching the credit spreads for high yield and investment grade bonds, and they've widened a very little bit. But this is what a problem looks like. That's the widening of spreads during COVID, meaning that there was investors were looking for a much more compensation for taking corporate bond risk. This is 2015-16. That was the China sell-off. And of course, this is the financial crisis. This looks nothing like this. we're looking at volatility, and volatility has moved up and out of the range that it typically stays in during a cyclical bull market. So that's another cause to be a little more cautious. So look, investing isn't about binary events. It's about making incremental decisions. It's about retesting your theories every day. And we're doing that. We're looking for change. But inflation continues to look as though it is the biggest problem that we have to hedge against. And the things that hedge well against inflation, like financials and precious metals, are doing exactly what they're supposed to do. We do have some cash, which gives us optionality for when this runs its course. And maybe it's a 2 or 3 month thing, maybe it's something longer. It probably is a 2 or 3 month thing. But it doesn't mean that there won't be new leadership on the other side by way of global stocks and more inflation-oriented securities. It may be that global stocks outperform US stocks for the next 10 years. And that wouldn't be out of the ordinary. So we have to be open to having money outside of the biggest 10, 15 stocks we all know. And if things get more difficult, we will raise more cash. So that's our history. That's our process. That's what we do. People don't have to phone and say, should I have more cash? We're assessing it every day. So with that, if there's any questions, certainly happy to answer. No fun seeing markets go through these kinds of machinations. It's perfectly normal. Market has 10% corrections every year, but we always want to continue to assess them. Take a look if there's any questions. Q&A. Here we go. Okay, regarding the shift in market you're viewing, what do you think about financials in the US? They still worth it, or is it better to avoid the sector? Look at keep in mind there are some of the best financials in the world in the US. And it doesn't mean you're making a bet on the US. JP Morgan is probably the best run bank in the world with the best systems, the best technology, the best balance sheet, arguably the best CEO. I would not be betting against JP Morgan. It doesn't mean we aren't reassessing everything. We're constantly assessing, but we continue to like the financial sector. And so we're there. Have we been trimming financials? So you can see earlier on in the presentation, we did take financials down by about 5 or 6%. That's just making sure we have some cash in the portfolios. Frankly, I would expect on any kind of strength, we're going to see the financials pull back, rally pretty quickly. So then it says, another question. We said earlier across the pools, we have 30 to 40% cash. Is the cash buildup a result of tightening stops based on market uncertainty for the past 6 weeks? Or was there prior? We had about a 3% or 4% cash position coming into the year, bigger. We took some cash, put on the sidelines preemptively as the Brett data started to change, and the rest would have been as a result of getting stopped out of positions. And I've always said, maybe it's repetitive, it's really important to make sure we don't let a little mistake turn into a big one. People say, well, market has lots of 10% corrections every year, and that's true, but it's also true that every big decline starts with a 10% correction. So look, we have to assess the situation as we go, and we don't expect it's something really big and nasty, but we take it day by day. Question: Barometer was an owner of GE Vernova. Do we still feel the same way? It did hit a stop loss. We got stopped out of that position. We think it's a great company, and very often we're not happy about getting stopped out of positions. But keep in mind, think of it this way: we only need 20 positions in a portfolio to have a well-diversified portfolio. There's 60-odd thousand securities we can choose from. When the situation changes, you got to be prepared to reevaluate. Realistically, we put on 20 positions and we're trying to buy things that are good, getting better. 2 or 3 work out way better than we ever expected. 7 or 8 will be pretty good, and a bunch aren't going to work. And it's not about being perfect. It's about advantage of the positions that work out, like a Fairfax, for instance. That's been a fabulous holding over the last 2 years. And some that started out with great promise will fail. And our job is to, constantly be sorting and then also saying, is there something better? In this case, right now, we just have cash and we're building our farm team. What is the GUTI in the chart? That was the utilities chart that we looked at. Where are we placing our cash? We do have some short-term bonds. We did put some money in the aggregate bond index ETF. We put some money in XBB, which is a short-term bond ETF. And we did put some money in some corporate bonds, which we feel very comfortable with the corporate credit. Can you recommend a copper stock? Look, we have copper stocks that we'd like to own, but we need to see the technical picture start to improve. 4N Mining, FOM. I keep an eye on Tech B. And I'd probably keep an eye on Hudbay, even though recently, it certainly pulled back after the most recent earnings. But we'll see when the time comes. And if you're on these webcasts, you'll hear us talk about it when it does happen. Is the equity pool restricted to North America? Could you buy global stocks as portfolio? Yes, we can buy global stocks. We do own ERG and that ERJ as an example, and we are in that portfolio. But we also, though, have our global fund, which I think is just really, really well set up for this environment. It's 80 companies, 40 high relative strength stocks that are high quality in nature, and 40 value stocks out of the total MSCI All World Index, which is about 895 companies. Assuming the end goal of the U.S. government policy with tariffs is to reduce the value of U.S. dollar relative to other currencies, so that an increased manufacturing footprint in the U.S. can benefit from an export perspective. What would you speculate would be the impact to U.S. equity and bond markets over the long term? Look, it's a great question. The strategy that Scott Bessent is talking about, weakening things, laying off people, cutting government spending, so that the government is less responsible for a big percentage of GDP and the private sector take over, is exactly what's being done in Argentina. And in Argentina, there was a period of higher unemployment and lower economic activity, followed by a handoff where the public, the private markets took over and the stock market's taken off. So I think that they are hoping to do the same thing. And that in the end might be a very significant win for the US. I think sadly, though, that they are burning bridges with relationships around the world. And the incentive to buy US products is, I think, on the table. The question is whether people want to continue to buy American things. And I would say probably in the short run, there's a lot of folks in a lot of countries around the world who are feeling that the US is breaking its social contract with Europe and NATO and some of its other partners like Canada and Mexico. So there's reasons why investors may be pulling in their horns with the US stocks. So we'll see. It just means there's uncertainty. With that, I think that's all the questions. I really want to thank everybody for tuning in. I'm hoping that markets will be a little calmer over the next few days, and I'll get a couple of days skiing with my kids. And we'll be back next Tuesday. But we're on it. The team is working hard. We're doing a lot of communicating. We're really focused on making sure that we stay on top of things. And when things turn, it's not going to be all at once. So it's okay. We're going to let a little water pass under the bridge here. and take our time and be methodical. All right. Hope everyone has a great week, and we'll see you again next Tuesday.